So let us continue with case scenario number 11. A Limited wants to acquire D Limited and has offered a swap ratio of 1:2, 0.5 shares for every 1 share of A Limited. Okay. Following information is provided: A Limited and D Limited, PAT given, equity shares outstanding, PE ratio and P is given. Routine computation. I don't think there should be any issue here. See, the number of equity shares to be issued by A Limited for acquisition of D Limited would be, see, only one thing in this question. If you see the previous question, one of the question we did where market price per share was given and we decided the swap ratio based on market price per share. That is, okay, they asked the question, what should be the fair swap ratio? We decided like that. Here, okay, the swap ratio is given in the question itself, which means they already decided that this should be the swap price, which means, okay, they have given that data you should consider. You should not calculate, because this will, if you see this, if you calculate based on this given swap price, say 7 rupees is the market price per share of D Limited and 15. So if you see 7 by 15, so let's say 7 divided by 15, how much is that? 0.4666. This into 7,20,000 equity shares into 7,20,000 if you do, okay, you will get 3,36,000. If you see, they have also given 3,36 as, one of the option, which means they want you to commit this mistake. Okay, anyway, swap ratio is given now 1:2 only you should consider. So 7,20,000 divided by 2, okay, how much is that? 3,60 is the correct answer. Next, the EPS of A Limited after the acquisition would be, see, EPS of A Limited after acquisition. Now first, post merger, okay, earnings, which is nothing but 72 lakhs plus this 14.4 lakhs you will consider as numerator, divided by, okay, post merger number of shares, which means existing number of shares is 24 lakhs plus what is the new shares issued for the acquired company. How much is that? 7,20,000. Just now we discussed now 3,60,000. So 3,60,000 you have issued. So 24 lakh plus 3.6 lakhs. How much is that? 72 plus 14.4 divided by 27.6. Okay, 3.13. Are you all comfortable? So this is the solution. Next, the equivalent earnings per share of D Limited would be, see, earnings per share of D Limited. Now, after the merger, D Limited, how many, what is the earnings per share? You see, very simple here. See, the EPS of merged entity. What is the formula for EPS after merger of this company? EPS of the merged entity into, okay, the ratio. Okay, what is that? Swap ratio. Okay, if you apply this swap ratio to it, you will get the value. For example, if you have 3.13 is the total merged entities EPS into the swap ratio will give you equivalent EPS of the D Limited. Okay, what is that? 3.13 into 50%. So 1.56 or 3.13 into 0.5. How much is that? 1.563. One rounded off to 1.57. Next, if A Limited's PE multiple remains unchanged, then market capitalization of A Limited after acquisition would be, see, market capitalization, MCAP formula. What is the formula? Total number of shares outstanding, okay, after mergers you will consider, into EPS after merger, post merger EPS, into PE ratio. Are you understanding why PE ratio will remain unchanged? Okay, the market price may change, but PE ratio will remain unchanged. You have to find out the total market capitalization. So number of shares outstanding, if you see, this is 24 lakhs plus 3,60,000, 27,60,000 into 3.13, 27.6 lakhs into 3.13. This is EPS per share into 5. PE ratio will remain unchanged. How much is that? 431.94 lakhs. 431.94 lakhs. Next, case scenario number 12. During one business meeting at ABC Limited, one of the numbers presented data relating to 3 companies, X Limited, Y Limited and Z Limited, whose operating income are equal, but their capital structure is different. Okay, now 3 different companies given. This is typical copy paste EVA question which is in your module. Okay, anyway, I'll just briefly discuss. I don't need to do the calculation at all. I'll just briefly discuss. See, total invested capital given, capital employed. Now EVA, what is the formula for EVA? EVA is equal to, you need to remember, okay, the what is that? See, the net profit after tax, EBAT into 1 minus T. You can also compare. This is nothing but no PAT. I call it as no PAT, net operating profit after tax, or simply this no PAT can be found out in 2 ways. I've explained. One is EBAT into 1 minus T, or if interest is given, PAT plus interest into 1 minus T. Okay, you will get the NOPAT. So NOPAT, net operating profit after tax. So EBIT into 1 minus T, NOPAT minus, okay, capital employed into WACC. Capital employed into WACC. Okay, this is the total capital charge. See, now debt assets ratio is given, not debt equity ratio, debt assets ratio. Shares outstanding given, post tax cost of debt given. For computing WACC, you don't need to convert, okay, to post tax, because already post tax directly you can consider. Then cost of equity given, operating income EBIT is given. The tax rate is uniform, 35% in all cases. The industry PE ratio is 10x. From the following information given above, choose the correct answer. Okay. The weighted average cost of capital of Y limited shall be approximately. See, weighted average cost of capital of Y limited means very simple. You have been given debt to assets ratio as 0.5, which means the debt. See how to find out debt. But debt ratio is 0.5. Okay, equity ratio, equity to total assets is also 0.5, which means weight of these two, debt and equity, is 0.5 and 0.5. What is the, let's say this is source, debt, equity. How will you find out either? Proportion, WACC, na? This is the column you use for WACC. So source, proportion, then you have cost, then you have weighted cost. Of course, value you have to have, but anyway, we can also find it like this. How much is the cost here? Let's say cost of debt is 8.45. Here you need to take post-tax cost of debt. I told you post-tax cost of debt will be used, and equity 0.5. What is the cost of equity? K is how much? 22%. Now 22 into 0.5, 11%. 8.45. 8.45 into 0.5. How much is that? 4.225. 4.225. So 15.225. Okay, this is what I'm getting. Y limited. I think it is Y limited. Weighted average cost. Yes, Y limited 15.23. B should be the solution. Let's just verify. Okay, case number 12. Case scenario number 12. Yes, 15.23, rounded off to 15.23. Next. The EV of X limited. See, EV of X limited. Now, first you need to understand what is EB80 into 1 minus T here. EB80 is 10 lakhs into 1 minus T. What is the tax rate given? 35%. So 65%. 10 lakhs is 6 lakhs, 50,000. So EB80 into 1 minus T, you will get 6 lakhs 50,000 in this case. Okay, for X limited, they've asked us to compute. Minus invested capital into WACC. Invested capital 40 lakhs. Invested capital is 40 lakhs into WACC. You need to compute again. Yes, WACC you need to compute. See, we will compute it. Debt assets ratio same way. Okay, here debt to assets ratio is 0.8. Right, debt into what is the post tax cost of debt? 10.4 plus 0.2. Then equity is 20%. 0.2 into how much is that? 26%. Okay, how much you're getting? 0.8 into 10.4 into 0.8. Memory plus 8.32. Then 26 into 0.2. 5.2. How much is that? 13.52. I'm getting as KO. This is WACC. 13.52 is KO. Now you multiply 14 lakhs. 13.52 percentage. How much is that? 40 lakhs into 13.52 percentage. 5 lakh 40,800. So 5 lakh 40,800 minus 6 lakhs 50,000. 109,200. I'm getting 109,200 as EVA. Are you all comfortable? How much is the 109,200? Now, next, price per share of Z Limited shall be. Okay, now, price per share. Now, generally, it is understood. It is to be understood as market price per share. So, first EPS, earnings per share, you will need to find out. Very simple. Operating profit was Z Limited. Which company they are asking? Yes, Z Limited. So, very simple. For 10 lakhs, you consider EB80. Just prepare the income statement. EB80 is there, then you have interest. How much is the interest now? Total invested capital 40 lakhs. Debt is debt to assets ratio 20%, which means 40 lakhs into 20%. How much is the debt portion? 8 lakhs. Into, see here, what you should do when you compute the interest from the EB80, you need to reduce interest now. You should not take post-tax cost of debt. You need to convert it to pre-tax and reduce the interest. So 8 lakhs is there. 9.75 divided by 65%. 9.75 divided by 65% comes to 15%. So this is, see, 15% is the pre-tax cost of debt. That only you should reduce from 8 lakhs, which is debt portion. So 40 lakhs into 2%, this is debt, into 15% will be the your interest. Into 15%, how much is that? 1 lakh 20. Interest is equal to 1,20,000 in this case. So interest for Z Limited is 1,20,000. What is the EBIT? 10 lakhs. 10 lakhs minus, okay, minus 1,20,000. We'll get EBT. Then you have taxation into 65%. You convert it to post tax. So 5,72,000. I get 5,72,000. This is PAT. Divided by number of shares outstanding 2 lakhs. So 5,72,000 divided by 2 lakhs. You'll get EPS 2.86 into 10x into 10x into 10. Okay, P ratio into EPS will give you MPS 28.6. Are you all comfortable? Well, is that 28.6 price of Z Limited? See, estimated market capitalization of Y Limited. Market capitalization is what? Number of shares outstanding into MPS, okay, of the company will give you this. So first step, you need to compute EPS, income statement, EPS, then MPS into P ratio and then MPS, then number of shares outstanding will give you market capitalization of Y Limited. Okay, see, anyway, I will just show you this, how to compute. Y Limited, where it is? Okay, Y Limited, first we need to compute, what is that? Interest portion. Total capital employed is 40 lakhs. 40 lakhs into 5, 20 lakhs is that. Then into pre-tax, so 8.45 divided by 65%. How much is that? 13%. So 20 lakhs into 13%. What is the interest? 2,60,000. Interest is 2,60,000 for this company. Now you should reduce this from EBIT. How much is that? 10 lakhs. EBIT is same for all the companies, 7,40,000. So 7,40,000 converted to post-tax into 65%, 4,81,000 divided by number of shares outstanding, 1,66,000. You will get EPS into PE ratio. You will get MPS 28.97 into number of shares outstanding, 1,66,000. Okay, you will get how much? 48 lakhs, 10,000 or something. 48 lakh. 10,000, where it is, yes, 48 lakh, 10,000. B should be the solution. 3 and 4, let's just quickly verify. 3 is, yes, A is the solution, B is the solution here. Okay, 48 lakh, 10,000. Next, earnings per share of X Limited. Again, you can go through, you can understand. Now, income statement you prepare, just number of shares, you'll get the solution. Straightforward issue. Next, case scenario number 13. X Limited is planning to expand its business and therefore raising fund by issuing a convertible bond of 10 crore. An investor, Mr. A, is interested to invest in the bond of XYZ Limited. Mr. A has the following data related to convertible bond. The data given below relates to a convertible bond. All these details are given. Face value given, coupon rate given, number of shares per bond, market price of shares, straight value of the bond, market price of convertible bond, maturity value of maturity period of 5 years. The conversion value, I told you in case, see, any convertible bonds question, you need to classify the price into 3. What is that? Okay, plain value of bond. See, I can say, what is that? Plain value of the bond, conversion value of the bond, and market price of the bond. See, let's say plain value of the bond, plain value of the bond, conversion value, okay, and then market price of convertible bond, market price of convertible bond. So 3 prices you have, very simple. Plain value of bond is given as what? Straight value of bond is plain value of bond, 940. Here I have 940. Conversion value, now, how many shares will be given for each bond into the market price per share? How much is that? 20 into 48. How much is that? 48 into 22. 960. So 960 is the conversion value. Then market value convertible bond is 1,060. So 3 prices you have. Now it will be very easy to segregate and solve. The conversion value of the convertible bond, straight away take it, 960 is the value. Okay. Now the conversion premium of the bond is absolute term. Now wherever they've given conversion premium, okay, you should understand that it is okay over and above the okay, conversion value of the bond. Very simple. Conversion value is how much? 960. Which means if you buy the equity shares from the market today, how much you have to pay? 960 you have to pay to get the equivalent amount of value. So 960 you will pay and get 20. You can buy 20 shares worth 48 per share, which means total conversion value is 960. But okay, instead of buying equity, you are fearful of buying equity today, but you are taking the conversion route. You are buying convertible bonds by paying how much? 1,060, which means here the premium, conversion premium. Now, what is the understanding? Premium over conversion value of the bond. In 9 for a, okay, for 960 value you are paying how much? 1060. So convertible bond, how much premium you are paying? 100 rupees extra you are paying to get this conversion option. 100 divided by 960 in percentage term. Oh, okay. They have to ask in absolute terms. 100 rupees is the answer. Are you all comfortable? The floor value of the convertible bond is represented by the plain value. Very simple. Floor value means, okay, if the equity shares become worthless, which means the company gone, okay, shut down, you tell me market price will become zero. Okay, shares will become worthless if business is, okay, is gone. Are you all understanding? So which means from 1060 you have paid 1060, the value will drop to how much? Plain value 940 will be the plain value. So that is called a floor value, straight value of the bond. Okay, C should be the solution. Just I'm showing you, okay, here the clarification. See, a straight value represents the downside protection or investment value of the investor. Okay, even if the equity shares becomes worthless, no point in converting. Okay, I'll die as a bondholder, which is the straight value of the bond will be the value of the bond. Are you all comfortable? Next, the upside potential of the convertible bond primarily depends on what? Coupon rate of the bond, face value of the bond, market price movement of the equity shares remain. This is the important. Okay, upside potential of the convertible bond. Now, if you buy convertible bond today, fine. Okay, and you can convert it to equity. When will you convert it to equity? See, when equity shares are, okay, keep on increasing, okay, then you will exercise the conversion option. You will become the shareholder. Because price movement, it depends on the market price of the equity shares. Anyway, by approximately what percentage the market price of the share should rise so that investors are in indifference between buying the share from the market and taking the conversion route. Which means if you buy the share from the market, you have to pay 960. Okay, if you take the conversion route, you have to pay 1060. Agreed? So approximately what percentage of the market price per share, market price of the share should rise so that the investor is indifferent. So for one bond, convertible bond, how many shares are being issued? 20 shares are being issued. Agreed? First of all. Now, existing, if you see, if you notice it, if you see, if you want to reach an indifference price, the conversion value and the market price of the convertible bond should be equal, which means the current conversion value should reach 1060. Agreed? Divided by 20. Now, what is the value? 1060 total value divided by 20 shares. How much is that? 53. Which means current price of the share, MPS, is how much? 48. This 48 of the price per share, if it increased to 53, you will be indifferent between, okay, holding a convertible bond and holding an equity share, or holding a bonded equity share, which is how much is that? 5 rupees is the increase. So 5 rupees is the increase from the current price. From where? 48. 5 divided by 48 should be the solution in percentage terms. 5 divided by 48, how much is that? 10.416, that is 10.42. B should be the solution. Okay, yes, B is the solution. Next. Case scenario 14. A Limited paid a dividend of 5 for the last year. The dividend is expected to grow at 25% for the next 6 years and 10% per annum forever. The standard deviation of the market return and A Limited share is 12% and 18% respectively. The correlation between market return and A Limited share is 0.3733. The return of government bond is 13% per annum and market return is expected to be around 20%. From the information given above, choose the correct answer to the following question. Okay, now the beta of A Limited share. See, in this question, if you notice, okay, beta is not directly given. They want you to apply CAPM, but directly not given beta. Typical question you have in security valuation, equity valuation segment, you have a similar type of question. See, beta is nothing but, okay, if you see the standard deviation of the security divided by standard deviation of the market, okay, and into correlation of S and M, this formula, one of the formula of beta is used here. So standard deviation of the security is how much? 12 and 18, which is the standard deviation of market is 12, security is 18. So 18 divided by 12 into correlation 0.3733 will give you the beta. So 18 by 12 into 0.3733, how much is the number? 0.559 or 0.56. Okay. Next, equity risk premium as per the given data. Equity risk premium is nothing but RM minus RF. RM given as 20%. Market return given as 20%, RF given as 13%. Very simple and straightforward. 7% is the solution. Next, the valuation approach can be used to compute the intrinsic value of A Limited share is single stage dividend discount model, CAPM valuation, two stage dividend discount model. See here what happens. Through CAPM, you will get the K. Okay, valuation approach to find the intrinsic value. It should be two stage dividend discount model, because here what happens here. Okay, paid a dividend for last year. So first, next to 6 years, it is growing at 25%. So here Okay, 1 to 6 it is growing at 10%. There, what is that? 25%? Yes, here 25%. Thereafter it grows forever 10% till infinity. Are you all understanding? Now this is two-stage dividend discount model. Okay, you may argue, sir, CAPM valuation model that is there. That is because to find out the KE you use CAPM. But here they have asked how to find out the intrinsic value of a limited share. So two-stage dividend discount model should be there. 3C should be the solution. Let's just check it. What they have given here. 3C. Dividend growth rate, yes, different growth rates are different. Two-stage dividend discount model. Next, question number 4. If the market price of a limited share is higher than its intrinsic value, the share is said to be undervalued. See, very simple. This is MPS and this is the intrinsic value, fair value. Okay, if the quoted market price is more than fair value, now obviously it is market price is higher than intrinsic value. Now it is overvalued. Okay, but I found something interesting here in the solution. I'll just show you. Okay, see, they've given the solution is B, that is not an issue, but the justification, reason, see, quoted market price is more than fair value. Now, fair valuation, I told you, it depends on investor to investor. If one believes that this is the fair value, now another may believe some other value is the fair value. So, if the quoted price is more than what he believes, okay, what value he will assign, then it is overvalued, simply overvalued. But here, there's very often the price of overvalued share is driven by hype, speculation, temporary option, as well as solid fundamental. This I believe is okay, unnecessary reasoning anyway, because see, the quoted price is more than the fair price, it is overvalued. That's sufficient. This it has a mistake here because obviously they are saying that it's driven by a hype, speculation, or temporary optimism that solid fundamentals need not be. The statement is not correct. Why I'm saying is, see, a company may have solid fundamentals like Nestle Limited, Reliance Limited, Tata, any company you take which is okay, so solid. Titan, for example, okay, very good company. If you see, the problem with that is, okay, if the company is having solid financial fundamentals, it will never trade in at cheap price. Okay, it will always be traded at premium price. It is not easy to get a okay good quality company for a fair price or even. Okay, it will be always overvalued. Okay, it is not only driven by hype and speculation. Even the companies which are strong fundamentals also will be trading at overvalued anyway. It's all, there is nothing no connection between the reason given and the question asked. Anyway, case number 50. The following information is available in respect of bond X and bond Y. Face value given, redeemable and yes, redeemable par given 1000. Face value same. Coupon rate is different. 6%, 10%. Time to maturity 5 years and 3 years. Next. Mr. A, an investor, has the portfolio consisting of 75% of bond X, 25% of bond Y. See, this is a typical bond immunization question. Okay, now we need to compute duration also. Anyway, I think bond A current YTMs prevailing in the market is 10%. This is a discounting rate given. Okay, now at the prevailing YTM, bond X will be trading at. See what happens. Current YTM is given as how much? 10%. YTMs prevailing in the market is 10% given. Now, the point here is, see, if you notice, the time to maturity here is, the coupon rate here is 6%. The coupon is less than YTM. If coupon is less than YTM, or to put it simply, YTM is more than coupon, the bond should be trading at discount. The bond should be trading at discount. Okay, if the coupon is more than YTM, if the coupon is more than YTM, are you all understanding? Okay, YTM is less than the coupon or coupon is more than the YTM, the bond will be trading at premium. And if this concept I already explained, okay, if the YTM is same as coupon, okay, the coupon is the only income which you will receive, there will be no capital gain or loss, which means the bond will be trading at par. The bond will be trading at par. And one more thing is there, the redemption also, okay, is important. If the bond is redeemed at premium, assume if bond is redeemed at premium or discount, it depends on the capital gain or loss, which means you can never say, in this case, the bond should, see, the fundamental assumption is that the bond should be redeemed at par. Then only, even if YTM is same as coupon, you can say that it will be trading at par anyway, because redemption value will also be considered in the cash flow. See, right? Anyway, so this solution prevailing YTM, the bond X, the coupon of X is less than, okay, coupon of X is less than the YTM. Then in that case, what is happening? It should be traded at discount. Okay, B should be the solution. Where it is question number, case scenario 15, B should be the solution. Next. The Macaulay duration of a bond is best described as time to maturity of the bond, weighted average time to receive the cash flows, and time until bond is redeemed, average coupon price. See, here also small mistake is that weighted average time to receive the cash flows, you should not say generally. okay, recovery of the cash flows, that, okay, it's not receipt of cash flows. And recovery of, yes, recovery of cash flows, but this cash flows, okay, the principal portion of the, this is, I should say, this is the, okay, the value of the bond, which means weighted average time taken to recover the principal portion of the bond or recover the intrinsic value of the bond. Anyway, just simply put it, receive cash flows is not correct. Okay, it is not original cash flows. It is the discounted cash flows. Okay, anyway, the value, I should say intrinsic value. Anyway, can be also average receive the cash flow given. Okay, these are all specific interpretation. Why I am saying interpretation is important. Now, in some other question, you may be getting into trap. If assume there is one option given as weighted average time to receive cash flow. Another option, they have given the weighted average time taken for receiving the discounted cash flow or the intrinsic value. Which one you should select? Intrinsic value, okay, or the discounted cash flow option you should select. That is the importance of the discussion. Next, C. Okay, dash carries a higher interest rate risk. Bond X or bond Y, both bonds cannot be determined. Now, in this case, we have to determine the duration. If you see, we have to determine the duration of bond X as well as bond B. Okay, the bond which is having a higher duration, because if the bond, see, YTM is given for the bonds of prevailing YTM 10%. If you see that duration, if see what is volatility, actually speaking, the bond which is having a higher volatility will have a higher risk, interest rate risk. Why? It will fluctuate more, no? So it will have more interest rate risk. But duration divided by 1 plus YTM is a volatility formula, rough formula, approximate formula. Convexity we will find out anyway. This is duration divided by 1 YTM. Now YTM is same as 10%, no issue. When the duration is more, assume the duration is 30 and divided by 1.1 UB. Then there is 40 divided by 1.1. Okay, if you do 30 divided by 1.1, how much you are getting? 27.27. And 40 divided by 1.1, how much you are getting? Okay, 36.36. Are you all understanding what I'm trying to say? Okay, ideally speaking, here, okay, the duration, okay, whichever is higher, they have given us more risky, because the time taken to recover the bond value, okay, the outflow will be more in that case. This is what they have given. But I would say you have to go till volatility and really find out the risk of these bonds. Okay, it also should be depending on the volatility. Anyway, they have calculated using a duration, if I'm not wrong, say which bond is carrying higher interest rate risk. The bond X is having longer maturity and higher duration, hence higher interest rate risk. See, in this question, I don't know what is the duration. I have not calculated the duration here. And they assume bond X. Okay, I've given it to homework. You can calculate the duration. Whichever bond is having duration, they are saying now bond X is having a higher duration, hence higher interest rate risk is assumed. But to be precise, volatility is a measure of the, because volatility is the sensitivity of the bond price with regards to the interest rate. So, but anyway, the duration is also important. This duration is Macaulay's duration. The volatility, okay, is really modified duration. It is also called as modified duration. Okay, now, here they have measured risk based on just a duration and not modified duration. That is what I wanted to communicate. Anyway, if the investor wants to reduce interest rate risk of the portfolio, he should dash increase weight of the, see, in this case, duration of bond X is higher. Okay, bond Y is lower. Where I got now after computing, okay, data given, I don't want to compute. There's a big solution steps involved. I don't want to do that again and again. Which means I don't want to do this in MCQ discussion. Okay, see what they said. Now X higher and low, the Y you have got lower duration. Now, see, if you want to create a portfolio, in this portfolio, if you want to reduce the interest rate risk, this is having higher interest rate risk as per their observation, duration is more. Now you want to, okay, put a lower duration security to pull back the overall duration less. Are you understanding? See, in both these questions, the general assumption is whichever bond is having lower duration is less risky. Whichever having lower duration is less risky. Okay, but anyway, I told you logic, duration alone is not sufficient. Volatility is a main issue. But anyway, this is the assumption for these two questions. Duration is the measure of the risk, and duration, if it is reduced, now here you have higher duration, risky, bond X, you create a portfolio, include Y, which is having a lower duration, so that the portfolio duration, weighted average duration, can be reduced. That is what is the meaning. Okay, if the investor wants to reduce the interest rate to the portfolio, okay, then what he should do? He should increase the weight of X, increase the weight of X, Y, increase the weight of Y. Okay, that is what is given in solution. Bond Y a shorter duration, hence lower interest rate risk is the solution. Okay, now from case scenario 16, we'll discuss in the next video. Okay, thank you.